Good evening, ladies and gentlemen. My name is Jagdeep Ahluwalia. I am the founding secretary of the 21-year-old Indo-American Chamber of Commerce of Greater Houston, which I currently serve as executive director. Today's webinar will be recorded and forwarded to all participants, and we may load it to the chamber website. On behalf of the Indo-American Chamber President Tarush Anand and our board, we welcome you to today's webinar. Tarush could not join us today, but he sends his greetings. We want to thank Swapan Dhairyawan for organizing and moderating today's webinar, and Mahesh Desai, a long-term chamber member, for sponsoring the event. We want to thank the Indian Doctors Association for partnering with us, and it is now my honor and privilege to introduce Dr. Jignesh Shah, the president of the Indian Doctors Association. Jignesh Shah is a partner of the Gastroenterology Consultants Group, the largest private practice GI group in Greater Houston. He is the president of the Indian Doctors Association of Greater Houston. He is an accomplished physician, medical educator, and double board certified. He completed his training in pediatrics, internal medicine, gastroenterology, hepatology, and nutrition at the University of Louisville. He serves as a clinical assistant professor at Baylor College of Medicine at the University of Texas Medical Branch. Few of his past appointments include chairman of Department of Internal Medicine, section chief division of gastroenterology, chief of staff and member of the executive board of Harris County Medical Society. Dr. Shah continues to provide pro bono administrative and clinical services to NPOs throughout the country. He received numerous accolades, including Physician of the Year and Rising Stars in Texas. Ladies and gentlemen, it is my honor and privilege to invite Jignesh Shah, the president of the Indian Doctors Association, to make some welcoming remarks. Dr. Shah.
Thank you, Jagdeep, for IACCGH's partnership. I would like to take a few minutes and talk about Indian Doctors Association. IDA's core principles are based on our new adopted vision of connecting, inspiring, and community. Quick overview of what we have achieved in the last year. We have held 16 events in 2019 and 5 events this year prior to COVID. COVID-19 has dampened our livelihood. However, it's taught us to come together as a community. As a physician nonprofit organization, we have responded to this pandemic by providing expert physician specialty awareness videos, telehealth support to those in need, financial contributions to the Houston Food Bank for the affected school children, surgical supplies to our first responders and younger physicians in training. I am also very happy to announce that our 2 medical school endowment scholarships have been given to University's School of Medicine and University of Texas Medical Branch. The scholarships will be awarded every year to students of Indian origin. Our hope is that it will foster the growth of caring and compassionate physicians in the Houston community who will become future leaders in medicine. On behalf of IDA, I would like to thank the panelists, Mr. Mahesh Desai, Mrs. Rimple, and our moderator and past president, Mr. Swapan, for today's discussion on the CARES Act. Executive Director, Mr. Jagdeep Ahluwalia, and attorney Tarush Anand have done an exceptional job in hosting these COVID-19 webinar series. They have covered all facets of this pandemic, including basic and clinical sciences, community and economic impact of this virus as well. Thank you, IACCGH, for providing these critical resources to our community during these difficult times. Thank you, Jagdeep.
Thank you, Dr. Shah. It's an honor and a privilege to be working with the doctors in this group. We are very privileged to have so many distinguished doctors serving the community, and the Chamber is proud to be hosting this event today with the Indian Doctors Association. It is now my honor and privilege to introduce the president of the Indo-American Chamber of Commerce, Swapan Dhairyawan. He is a past president of the Chamber, a very strong supporter of the Chamber, and a community leader. He is a practicing CPA and founder of the full-service accounting and tax firm, MD & Associates. He founded it 15 plus years ago. He has a master's in accountancy from Bombay University and CME designation too. His firm specializes in small and mid-sized businesses from various sectors and services. And Swapanji, when he took over as president of the chamber 2 years ago, 2.5 years ago actually, brought an emphasis on serving the small businesses a lot more proactively under his tenure. And Tarush continues that practice of serving the small and mid-sized businesses. So it's our honor and privilege to welcome Swapanji to moderate the panel. And we want to thank both Maheshji and Rimpalji for accepting to be panelists, and Maheshji for sponsoring today's event. So Swapanji, it's your program. I'll come back at the end to offer my thanks on behalf of the chamber.
Good evening. Thank you so much, Jagdeepji, for all the kindest words. And thank you to the chamber for doing this series, which is so very needed in this unprecedented times. Thank you, Dr. Jigneshji, for partnering with the chamber. We have been doing so many things together, and this is one of that programs in which we are focusing a little bit more on the physicians and their practices, plus of course the community at large, because this economic boil down is unprecedented, and which is everyone has to cope up with that. That being the case, the things are dynamic. When we started this, the COVID got started, the Congress went back and came up with a couple of bills, and I'll be talking about that later, how that was the history and how the origination happened, kind of a thing. And before that, I would like to thank my panelists, of course, Mahesh Desai and Rimpal Mashruwala. They have been wonderful individuals who have been supporting me for the last 8 to 9 years for any of the tax seminars and the panels that we go together and work on. It is fortunate to be living in this kind of Houston community in which we give and take together, in which we educate ourselves together, because it's a global, it's so very dynamic, I would say. And the big thing in this entire COVID crisis is the 8-letter word, which I'm stressing to most of the people, to my clients, of course. That is the 8-letter word is patience. That's a big thing, because things are changing. The guidances are coming very slow. Do not get overactive about that. The things would fall in place. The only thing which is needed now is patience. That being the case, I would like to welcome Mahesh Desai. Mahesh Bhai actually has been a practicing CPA and a certified financial planner for 20 plus years in Houston. And he volunteers in various other community organizations, temples, and of course for the chamber as well. So I would like to invite him to present his presentation, which is, we are going to do it in 2 parts, kind of, because the topics are so vast, and 1 hour is not exactly kind of a limited time to go over all the facts of it. But let's see how much we can catch up. There would be questions which will be coming up. We already have a few questions which have been lined up. And of course, you can put your questions on the chat as well. So we will moderate that and we'll ask our esteemed panelists to talk about that. So before I bring up Mahesh Bhai, I would like to give a 1-minute thing on the CARES Act. The CARES Act which got passed. It got passed so fast, the $2.2 trillion stimulus bill. It contains a holistic approach of all the things which are there, which are going to help the community and the economy to come back. The intent is to bring back the community, to bring back the crisis from which we have been facing. So there are various factors, various layers to that. The stimulus, the net operating losses, the RMDs, the charitables, the PPP, which is the biggest part, and most, I would say, half of the people who might have been joining in will be related to PPP. So without any further ado, I'll first ask Mahesh Bhai to go over and talk about his presentation. Mahesh Desai.
Thank you, Swapan. Thank you, Jagdeep. Thank you, Tarush and Bhavna for supporting in running this webinar. This series was started a few weeks back and it is continuing. Thank you, Jignesh Shah, President of Indian Doctors Association, for partnering with Indo-American Chamber of Commerce. And thank you to all the medical professionals and other business owners listening to these presentations. You are heroes in the line of defense against COVID-19, and your dedication, commitment, and courage is appreciated by the community with the deepest gratitude. I'm humbled to present before you today, and my presentation will take approximately 15 minutes, and then Rimple will take over. I'm going to talk now about the PPP loan. So Bhavna, next page. Next one. Yeah, so the PPP check protection program, paycheck protection program is something regular business people knows, but it is also available to the medical professionals. And the reason why this program came up is because everybody's revenue has gone down due to the fact that the people are not moving around. They are not able to do their normal lives. So the employees are not coming to the work. And so the business is impacted. The government came up with some steps, and the steps were to keep the blood or oxygen flowing in the sense that the money is flowing to the people so they can get back to their normal life once this virus goes away. And with that, the government came out with a unemployment insurance and loans to the business enterprise, big businesses, airline, so on and so forth. And we have seen many other businesses taking advantage of this paycheck protection program. The important issue is that this program is also available to the medical practitioners or medical practitioners group or anybody who is practicing medicines on their own or in the group. So now I will talk to the finer points of the paycheck protection program, or we normally call PPP. And the PPP is a money that comes from, if you apply, then money comes to you from the SBA or SBA approved lenders, and it comes to you as a way of loan. Now, this money, the loan amount is calculated as 2.5 times of your monthly payroll, and they multiply that monthly payroll by 2.5 times. This money is given to the businesses to pay the employees so that the employee can hang on with you, and when the virus goes away, you are back to normal. And that is a goal of the PPP loans. The way it works is that you apply this PPP loan with a bank with whom you have a relationship or with any other lenders approved by SBA. Once a loan is approved, it's very easy process. It's funded. You get the money in your bank account, and you have to use 75% of the money for paying the payroll. You can use other 25% for paying rent, mortgage interest, or utilities. And if you do that in next 8-9 weeks after the loan is funded, then you can submit for the forgiveness. The forgiveness is condoning the loan repayment. Once the loan is forgiven, you don't have to pay it. Whatever portion is not forgiven, that you have to pay it back with 1% interest, but you have a first 6 months of deferment. So this is a very good program that physicians can take advantage of. And it's because during this challenging time, the patients are not coming to you and you are not able to bill to the insurance company. So your cash flow has dried down, but you need to get back your employee and you need to keep them even if they are not coming and working for you. So once everything gets normal, you should be able to have your same employees and you can get back and you can continue. So this is basically the PPP program. If you have not applied yet, I will encourage all the physicians to go and start looking into it, because it can be substantial. If your paycheck is, let's say, monthly $40,000, 2.5 times is almost $100,000. $100,000 comes to you as a loan. You can use it to pay your employee and you can sustain your practice easily. So now, next slide, I will talk about the forgiveness. So many of our clients have already got the money. You can still apply for this PPP program until June 30th of this year. And once you get the money, you have to document that you have spent this money for paycheck in utility and other rent. And then once you submit this documentation to the bank, bank will give a forgiveness of this loan, and bank may submit it to the SBA, and SBA may look at it randomly just to make sure that they are following the program. But once that is done, the loan is forgiven. So you don't have to pay it back. So essentially, indirectly, this is a help. If you follow through the guideline of the PPP program, then the money comes to you from the federal government and you don't have to pay it back. Next one. So now, this is one program. PPP is a one program. The second program is the employee retention credit. And why this retention credit came is because many employers who are not small, less than 500 employees, are not eligible for PPP program. But if you retain the employee and if you keep paying them, then government says, okay, we have another options for you to claim the credit. So that is called employee retention credit. The government has changed the rules in the sense that before they were saying you can use both employee PPP as well as the retention credit, but now they have clarified that if you have obtained the PPP, you cannot use the employee retention credit. And today was the last day, I guess, to return the loan back, PPP loan back to the government. So employee retention credit is still available, and it's very simple. So this is how I will explain in a very basic terms is if you are paying one employee $10,000 for this quarter, then you can get up to $5,000, 50% as a retention credit. And that can be used against the employer portion of the payroll taxes. Now, if you have more credit than you have to pay, then you can get that money back also. However, the details of this paycheck retention credit is two things we have to keep in mind, that the employer whose business was shut down either fully or partially during this COVID-19 period is eligible, as well as those who have suffered a significant decline in gross receipt as compared to the previous quarter of the previous year. So if you have suffered, if your revenue has gone down because you could not see the patients, then naturally you can be a good candidate, your business can be a good candidate for claiming a retention credit. And this retention credit can also be used for those wages that you paid for some of your employee for their sick pay, or if they could not come because of their family, somebody was sick in the family. So family leave as well as the sick leave that you paid for, you can use that credit against that. This credit is also available for non-profit organizations. Now, I know many of the physicians, they provide services to the pro bono, to the non-profit association. So if the non-profit association has the employee, and if they are continuing to pay them, they should be able to use this benefit for non-profit organizations also. Next one. So now you have, this business has gone down, your revenue has gone down, and you have your employees, you are paying them, and so you have a liability to pay the employer portion of the taxes and also the employees portion of the taxes. If you have to pay the employees portion of the taxes to the Uncle Sam right away, or as and when it becomes due. But for the employer portion of the taxes, the government says, well, we understand you are going through the hard time, difficult time. If you don't have the money, you can pay us. I mean, first of all, you can use your retention credit if you are eligible and if you have those. And then even if you, after that, if you owe some taxes, then you can pay in a 2 installment, which is the first one is until December 31st, 2021, and the remaining is until December 2022. So for employer portion of the taxes, you have almost 2.5 years to pay. You can skip this year, you can pay half next year and the half following year. So that's a very good liquidity or the cushion that government is giving you to keep running your business. So that's very important. You can work with your payroll company or whoever is doing the employee's payroll. Make sure that you bring up this issue before their attention and use this to delay paying the taxes so that you don't have a cash flow shortages. Next one. So the advanced tax credit is, as we discussed, if you have many employees and you choose to claim retention credit and your retention credit is more than your employer portion of the taxes and you want that money to be refunded to you, then IRS says, yeah, we'll give you your money. You just have to fill up this Form 7200, send it to us, and then we will send you the check. So this is something the government is taking very proactive steps to keep the employment and business running in operation as soon as the virus situation subsides. So this is one of the important things. Usually it's very hard to get the money from the IRS. It takes time. Right now, most of the office of the IRS is not working, but they have promised that they should be able to get this money quickly if they get your Form 7200 completed in a due course. Next one. So now you are having a difficult time, and it's a different time because you are seeing the patients maybe through the remote telemedications, and you are having this issues of seeing the patients remotely via WebMD, and you need some better diagnostic equipment or maybe better camera to interact with them. So you have a chance to improve your business property. And if you improve your business property right now, you should be able to claim the 100% bonus depreciations. And also the business of medicine delivery is changing so that you may see more patients now, or you may have started seeing some patients via remotely. Maybe it may be true for the primary care physicians and not for the specialties or surgery center or whatever. So some of these issues are going to be changing the way you deliver the practices, and you may have to modify your practice delivery. And if you do those expenses, then you should be able to write off the expenses as a qualified improvement property. And it gives you a extra benefit of 100% depreciation that will reduce your taxes, reduce your net income, and that will reduce your taxes. Next one. So now the relief of individual for retirement from the retirement money. I know many of the physicians may not have to use their retirement savings to continue their operations, but those who are starting out, young physicians who have just finished their residency and they need some money, they can take it out for whatever reason. I mean, we saw some marriage or house, buying house or whatever. They can use their retirement money. In normal course, if they withdraw that money, then, and if they are under 59.5 years of age, then they have to pay the penalty and taxes. But for this year, they have waived the penalty. You don't have to pay the penalty if you withdraw from your 401k or IRA or retirement plans, and you can use it without paying the penalty. You still have to pay the interest. However, this is a little bit narrow exemptions. The IRS says that somebody has to be diagnosed with the COVID-19, or some spouse or dependent person was impacted by that, or you have suffered adverse financial consequences because of the quarantine or furlough or laid off. So there are some options available if you want to use that money in the case you need it. Next one. So as we discuss, you are running your practices. You may have a revenue impact because of the not able to see the patients, and also you are having expenses of paying the wages and paying the rent and all those things to keep the lights on. So now you are going to have a maybe operating losses. And that is where I just want to clarify these three items so that I can remove uh, I can throw some more light on this one, is that what losses can be set off and what losses can be carried forward. So basically the active income is where you are working and you are putting your time and skills and efforts. That's the active income. Now you may have some portfolio income because you made some investment in in stocks or wherever, and you may have some dividend interest or royalty, and those are called portfolio incomes. Those are taxed at a different at a preferential rate, and then there is a passive income. If you have an investment from the rental property, rental income, limited partnership income. So these three categories of income are are treated differently by the IRS, and so in passive losses, there are some restrictions, and I think Rimple is going to cover that. But mainly, what I want to emphasize is that next page, the active income. If you have active losses in the active income because you are operating your business at a loss due to the increased expenses and due to reduction in the income, you are billing, or maybe the payment is not coming through, or whatever reasons your income has gone down, then you can use that net operating loss of this year to take it back in the past and use it to set off the past year taxes and claim the refund from the IRS. So the law allows you to take it back and use it for setting off of the previous year high taxable income so that you can get some refund. And that's the goal of the new legislation that they gave some relaxations in terms of using these losses. Now the passive losses has to be carried forward, and set off against the passive income. But that is, I think, I will leave it there, and Rimple will cover that. Next one. So you have a planning opportunity here. A tax law is changing. There's a turmoil in the market. You may have some distress opportunity in the real estate. Some surgical center or some medical practices group may have some relocations or may go through some turbulence in this type of situations. The technological changes are forcing you to change the way you deliver the services. Cloud computing and working from home are enabling employees to seek the medical services from you via iPhone or whatever. So there's a lot of changes that is coming through the market. And the virus has created a further stress in the situations. And that is why I would say that in the middle of difficulty lies an opportunity. And if you think that these current times are surely providing the difficulty and you need some solutions, we are there to help you. We can find some opportunity. And with that, I think I'll pass it on to Rimple, and she will continue on her presentation.
Thank you, Maheshji, and thank you, Swapanji. Thank you, Indo-American Chamber of Commerce. Can you hear me?
Hello.
Hello. Swapan, can you hear me?
Yes, I can hear you.
Okay.
First, I will introduce Rimple. Thank you, Mahesh Bhai, for covering the topic very well. So before I introduce Rimple, there were a couple of questions also coming up. So I would like to say those were good questions, and please hang on till the last, because after this Rimple's presentation, we'll be taking all the questions up. One thing which Mahesh Bhai did mention about safe harbor, some guidance has come actually today regarding the PPP loan. The PPP loan, the first phase which came up was 349 billion, and it was exhausted within 10 days. The second one which came in, which is close to 310 billion, which is still up and running. So you can reach it through your bankers, through your preferred vendors, and do the applications on that. What Mahesh Bhai said earlier was about the safe harbor was returning the loan back. What has happened is some of the businesses who thought they were small businesses, qualified under that, and they tried to apply under that, and they took the loans. But SBI reminds them, and they say that when you had applied for, you had certified that the current economic uncertainty is making you make this loan request. But if the operations which you're going through are sufficient enough with your present cash flow, you need not take this loan. So basically, most of the people who had applied, the big ones, they were given this chance to refund, and they have extended that date to May the 14th instead of today. So just wanted to have that safe harbor clarification which came in. So every day it's kind of dynamic. We are just kind of reading every day what's happening to this forgiveness program and everything. So with that, I introduce Rimple.
Swapanji, I would just like
Yes.
to interrupt with the disclaimer, because if you could also make the disclaimer on behalf of the chamber and the IDA.
Yes, with that disclaimer, I was going to come towards the end, but the disclaimer is, yes, do reach out to your tax advisors, professionals who are great persons, and the AICPA website itself is quite exhaustive. They are very robust, and they are taking every issue out of this, because this is a global pandemic. Just like the health professionals are in the first line of duty, we as essential workers are out over there, because those are papers and money which is involved as well. So reach out to your tax advisors, to your professionals and tax preparers if you have specific questions about. This particular panel has been put up for the education of the community and professionals itself. Some final points may not get covered totally during the presentation. So there is a lot of hearsay which might go by. So do your due diligence also, and reach out again to the panelists if you want to separately. So with that, I would like to invite Rimple. Rimple Mashruwala, CPA, is a practicing CPA for more than 13 plus years. She is passionate about helping small businesses achieve their financial success. She is currently leading a firm helping businesses and individuals navigate a myriad of changes. With that, Rimple, on to you.
Thank you, Sopanji, and thank you, Maheshji. Thank you, Indo-American Chamber of Commerce, for giving me this opportunity. And like Sopan said earlier, yes, we are going through the tough time and navigating all these changes and the new rules and regulations coming along every day. So, yep, it is a challenging time for everyone, and for us, and for the people who are who are relying on the support of our nation's charities to get help. The CARES Act made, so I think let me start with my first slide. The next, yeah, the CARES. So I'm going to cover the charitable contributions, changes related to that, and the net operating losses. So let me begin with the charitable contributions and the changes it brought. So the CARES Act made significant changes to the contribution limits to encourage giving during this difficult time of need. And one of the provisions of the CARES Act was it significantly increased the limits of what can be deducted. So earlier, TCJA limited the deductions of cash contributions to qualified charitable organizations to 60% of the individual's adjusted gross income. This is only applicable to the people who itemize, though. Under the CARES Act, however, the deductions for cash contributions to a qualified charitable organization in 2020 is increased to 100% of the individual's adjusted gross income, meaning you can deduct whatever income you make, you can deduct 100% of it towards the charitable donations, and furthermore, you can carry it over to the following 5 years. Whereas under the prior law, so that's one of the biggest changes that the CARES Act made regarding the charitable contributions pertaining to the individuals. Now, pertaining to corporations, the corporations earlier could only take 10% of their taxable income in terms of the contributions towards charitable organizations. The CARES Act increases the limitation for cash contributions to qualified charities in 2020 to 25% of the taxable income, of such corporation. The corporation can also carry forward and utilize any excess amount over the following 5 years. In addition to the above, limitation for deductions of contributions of food inventory by a corporation is also increased from 15% to 25%. So these are some of the changes pertaining to individuals and corporations. There's some more changes regarding charitable contributions. If you can switch to next slide. Yes. So above the line deductions. Under the prior rules, individuals who do not itemize their deductions in their income tax return basically could not deduct anything on their charitable donations. Under the new CARES Act, the individuals who do not itemize would also be able to deduct up to $300 of charitable contributions as above the line deductions. This is even if they do not itemize, they would still be able to deduct. The only condition is the deductions must be made in cash and it must be made to one of the 501c3 organizations. No private foundations or no donor advice fund is allowed. So it's something to keep in mind. Next slide, please. With this, I'm going to go over to the rules pertaining to the net operating losses and some of the way businesses can apply for the quick refund using their net operating losses from the earlier years. So, let's begin with why net operating loss deductions matter and the treatment under the current law. See, net operating loss deductions are built into our tax code, so businesses are taxed on average profitability over time and are not penalized for having volatile income over uneven earnings over different tax years. Say, for example, without annual deductions, two firms that earn the same income but in different tax years may pay completely different taxes. For example, imagine a firm 1 that loses 50,000 in its first year but earns 100,000 in the second year. A second firm, firm 2, earns 25,000 in both years. In absence of the annual deductions, the first firm is taxed at a 42% effective tax rate over those 2 years, while the second firm faces an effective tax rate of just 21%. The first firm faces a much higher effective tax rate over these 2 years. So that's when the annual comes into picture. When annual deductions are available, both firms face an equivalent effective tax rate, and the firm with uneven income is not penalized for losses accrued in 1 year. Annual deductions are an important aspect of the tax code to ensure neutrality between businesses and industries that experience variations in profit over years. While annual deductions move the tax code closer to neutrality, the tax code still treats annuals less favorably than profits under current law. When a business makes taxable income, it is taxed that year at the marginal tax rate. However, if it generates a loss, it will have to delay taking the deductions associated with the loss until the income is earned in the future. In other words, if you make profit, your taxes are due right away. But if you have losses, then you get to carry forward. So Uncle Sam's win here. The tax asymmetry faced by businesses with losses means that businesses are penalized for losses in the tax code. They must carry over losses accrued in any given year to future years when they may use those deductions to offset or reduce the taxable income. The longer a business must wait to deduct an annual deductions from future taxable income, the smaller the tax benefit it receives. So this, with inflation adjusted, if you wait for future years to get your NOL, then the time value of money goes down. So the CARES Act provided economic relief to individuals and businesses struggling during this coronavirus pandemic. And as a result, annual deductions rules were modified to provide additional liquidity for businesses that may otherwise lay off workers or shut down permanently due to downturn. So think about it, review your couple of years tax returns and see if you can take advantage of any of these annual rules. The CARES Act provided economic relief to individuals and businesses both. So prior to the Tax Cuts and Jobs Act, in general, an NOL could be carried back 2 years and carried forward up to 20 years. I think Mahesh, you already mentioned that. Effective for NOLs occurring after December 31st, 2017, the 2-year carryback provisions was repealed and annual carryovers was limited to 80% of the taxable income for the year in which it is carried to. So basically, you were limited to only 80% of taxable income while using the annual, and you could not go back. Yeah, so the next slide says this is a good chart that I pulled up, and it explains in general what you can do for which year. So for example, 2015 is generally not amendable, so we cannot do anything for 2015. For 2016 and 17, we still have 3-year carryback, and with this new rule, indefinite carry forward. For 2018, 19, and 20, we have 5-year carryback, and we have indefinite carry forward and no 80% cap. So review your options, see where you stand, see if any of these rules can help you benefit. If you have current year losses, if you have losses in 2019, review with your tax professionals and see if you can apply for a quick refund out of it. And as you can see, the earlier rules, the pre-CARES Act or pre-CARES world that we say, we were limited to no carryback and indefinite carry forward, and only 80% of the taxable income can be offset against the NOL. So there's much of the changes brought in by the CARES Act. Basically, it undo some of the TCJS rules. Next slide, please. So getting cash immediately by filing tentative refund claim. So how do you apply for this quick refund, right? So a taxpayer with an NOL carryback may file an application for a tentative carryback adjustment of the tax for the prior tax year affected by the NOL carryback. The tentative carryback adjustment is designed to provide the taxpayer with a quick refund as a result of the NOL. The IRS has 90 days to make a limited examination of the application, as opposed to 6 months. Previously, it used to be 6 months to approve your refund claim, right? Now they just have 90 days to approve your refund. Individuals use Form 1045 to apply for the tentative refund, and corporations use Form 1139 for the same. Next slide, please. So due date for tentative refund claim. So there are much changes for the due date as well. Prior to CARES Act, due date for filing the tentative refund would be 12 months after the tax year. So meaning 2018 tax return, you can apply for a refund only until December 31st, 2019. With this CARES Act, extended this deadline for an additional 6 months. So now you have until June 30 to amend and get the refund out of your 2018 calendar year. Next slide, please. So I just put up an example. So taxpayer had an NOL for 2018 calendar year. Under prior rules, the taxpayer would have until December 31st, 2019 to file Form 1045 or Form 1139. Under Notice 2026, the taxpayer now has until June 30th, 2020, which is just about a month and a half, to file Form 1045 and Form 1139 for 2018 calendar year net operating losses. The application must say on the top that Notice 2026 extension of time to file application for tentative carryback adjustment. So certain things to keep in mind while doing your application, and this is the fastest way. You have 1.5 months, and deadline is appearing. So please work with your tax preparer and see if you can qualify for any of this. Next slide, please. So I think I forgot to mention earlier, one of my slide had it, that the 5-year carryback is must. So if you have an NOL in any of these years, 18, 19, you have to go back 5 years first before you go forward. So, but there is an exception to this. This slide discusses that. Waiver of the 5-year carryback rule. So let's see. Such election must be made no later than the due date, including extensions for filing the taxpayer's federal income tax return for the tax year after March 27, 2020. So any tax return that is due after March 2017, March 27, 2020 is the date when the CARES Act passed. You have to make an election to waive your carryback option on any of those future tax returns that you file. And the attach to the federal income tax return a separate statement for each tax years for 2018 or 2019 for which the taxpayer intends to make the election. So make sure this is done correctly so that you can properly waive your carryback option if that's to your advantage. Once made, the election is irrevocable. So you should definitely consider it, seriously and see if, you want to make this election. Next slide, please. This is interesting. Section 461L, excess business losses. So one of the provisions that the CARES Act brought was it delayed the applicability of Section 461L. Under pre-CARES Act, so before the CARES Act was passed, pass-through business owner could not offset more than 500,000 of losses with their non-business income. But after the TCJA, TCJA actually limited this deduction from 2018 to 2025 tax years and treated this excess business losses as an NOL to be carried over in future years. But now with the CARES Act, what it did was it just shifted the application of this section to a future date. So it postponed it to 2021 to 2025. So now, unfortunately, taxpayers who got caught under this net during 2018 can still be able to amend their 2018 return and reconsider their options and see if any of this NOL can be to your advantage. We are looking for some additional guidance from IRS, but we just have to wait for now. There's no set deadline, but consider it if it is an option for you. Next slide. COVID relief for partnerships with NOLs. IRS issued a Revenue Procedure 2023 allowing eligible partnerships to file amended partnership returns using Form 1065 by checking amended return and issuing amended K1s so that partners can take advantage of some of the CARES Act. CARES Act modified this pass-through. Owners may now use NOLs and issue an amended K1s into that effect. Next slide. I think that was my last slide. And in the conclusion, I would like to say, while these changes give businesses with losses more breathing room, businesses must have net income in the last 3 years to deduct these losses and realize a tax benefit. Many businesses, such as startups, recently launched businesses, may not have been operating in these tax years or may have run losses with the goal of reaching profitability in the future. But these businesses may also have accrued NOL deductions, but do not have any opportunity to use them. So we will wait for phase 4 of this act to be released and see if there are some other advantage to the newly open business and startups and the businesses who doesn't have NOLs. So we will see and watch carefully. And with this, I think I concluded my presentation, and I'll be happy to take the question and answers with Swapan in the end. So Swapan, back to you. Swapan, are you there?
Swapandi, are you there?
I think we kind of.
Yeah, so Swapandi had texted me.
He's there.
He's having some issues. So I'll take over the questions at this point. The first question is, I received an email today that the loan return deadline was extended to May 14th. I believe you've already addressed that, Maheshi, and in your talk, or Swapandi mentioned that. So I think that is covered. The next question.
Hello.
Hanji Swapandi, are you?
I'm back. I'm back.
Okay.
I'm back. Okay, I'm
back.
back. Sorry about that.
Perfect.
Sorry about that. I had lost somewhere. So there were a lot of questions. We might have an overrun of about 5-7 minutes more. So there was a question about the stimulus check. If you don't receive it by end of June, what happens? whom do we contact? So the answer is simple, irs.gov. They have a very good tabulation over there, and you can go on their tracking system and you can see whether your check has been mailed or a direct deposit has happened. There are 26 million taxpayers still in the wait, and patience, the 8-letter word, as I said earlier, is important. The money will come. That money is not going anywhere, so it will come. There were a couple of other questions for Rimple, I would say. One was regarding charitable contributions, whatever you said. That applies for the tax year 2020, correct?
Yes, that applies to only tax year 2020.
Yes, okay. So that was one clarification. The other clarification someone wanted was, does carry back apply to S Corps?
Yes, it does apply to S Corps. But
Okay.
it has to be taken on the personal return.
Personal return. Yes, it will flow through on the personal return as a K1.
Yes.
Mahesh bhai, there were some other questions for you as well about the PPP, and it talked about if you received a PPP loan and received more than you will actually be able to pay for all the employees full time, will you still be forgiven for the 100% of your 8-week payroll and the excess treated as a loan due in 2 years, or will none of the amount be forgiven?
No, it will be forgiven to the extent that you can document that you use that loan to pay for the wages, and the 25% of the loan can be used to pay the rental expenses and utilities. So you can use as I said, and then if you have still more, and if that is not forgiven, then you have to return that. So partial forgiveness is possible. It's not like 100% forgiveness or no forgiveness or zero forgiveness. It's not like that. You can be forgiven partially.
There was a question about, under the PPP guidelines, when does the 8-week term starts? What if the business is still closed with stay-at-home orders from authorities and the PPP has been funded?
Okay, so the 8-week period starts from the time the loan is funded, and you continue to pay the employee for 8 weeks, and then you submit it for the forgiveness. But if the business is still closed, I don't think they are going to give any more loans. So that's my take.
No, the thing was, the clarification on that was a little bit on the other side, because the thing is, the loan has been disbursed on the anticipation that the business will get started. The money has come through, but the business hasn't gotten started because the stay-at-home order just got out and the employees are still not there or whatever. So how does that work? So the answer is still the same. Money disbursed is what it is. Intent is more important in this scenario, because the forgiveness package, when it happens after 8 weeks, you will have to satisfy, because everything is self-attestation, and you will have to do your due diligence in attesting that you did your best in getting the thing started and making the payments to the employees or whatever that was. There was another question
Swapanji,
yeah.
In the case that you just mentioned, if the employee has to stay at home because the business community has not been allowed to open those businesses, the example being, let's say, a nail salon that has not been allowed to open.
Exactly. So that is still the home order. Then what happens is, basically, if the money has come to that home salon, nail salon shop or whatever, they will have to document it when it got started, actually. Say, suppose not on the 8th of May, it got started on May the 16th. Yeah. While the funds have come to them on May the 5th, they will have to document it from there onwards, kind of.
So I would also suggest that every individual on this call visit the SBA website for any update, because what we have found with the current program is every 24 hours, the rules seem to be changing. So
the rules are not changing, Jagdeep ji. It's very dynamic, okay, because every situation is different. Every business, every individual case is different. That's why SBA has every morning 9 a.m. webinar about the PPP forgiveness. If people want to do a specific thing, they can as well log in on that and do some questions as well on that. That should be fine too. But the best scenario is go to your tax preparer, takes the tax advice. Mahesh bhai, you had to add something on that?
So what I was saying is that based on the question, if you got the money for 2.5 times, which is like 10 weeks of your average, 2.5 months of your pay, average pay. So, and if you are paying the employee, then the money should get exhausted. And if you also paid rent and utility in that next 2 months, so there should not be any money left if you continue to pay the employees. Now, if you stop the employee paying, then that's an issue. So that
Yeah.
the issue for the forgiveness, because the forgiveness depends on the condition that you continue to pay the employee, and the way the amount is calculated, you get paid for 2.5 months of the wages. So you pay let's say you pay 2 months, and then you use some of the money for rent and utility, then you are running out of the money. If the business is still closed, then the third month or fourth month, you don't have any money. So there is no issue of overfunding the loan or asking for the forgiveness. You just have to think about it. When should I open it, or how do I manage the cash flow after 3 or 4 months?
One more question has come up regarding PPP. In PPP, when you're going to rehire the furloughed employees, but the employees don't want to return to work as they get more money from TWC, can an employer hire new employees or give raise to the employee who are showing up for work?
Yes, that is possible. And we have heard that, I think the government also heard this issue loud and clear, that based on the unemployment status, they get more money for being unemployed rather than coming back to work. So that's one of the Florida senator raised this issue, that this whole program needs to be re-examined or re-looked by the Congress, because we are giving more money for not working rather than working. So that's an issue that is being considered right now. And so we'll have some more guidance in the...
For that guidance today itself, I saw a FAQ, Mahesh bhai, and that is FAQ 40 and 42, which AICPA Journal of Accountancy has also clarified. It clearly states, employees and employers should be aware that employees who reject offers of re-employment may forfeit eligibility for confirmed unemployment compensation. So it's an important thing. If they are getting funds from the unemployment, and if they were furloughed, but they have been offered and they are not going in, and if you document it as an employer correctly, that they are not coming back or whatever, they can be stopped unemployment. So that is something, I would say, sunshine over there.
Yes.
So some clarification guidance has come today actually.
So it's the employer's responsibility to inform the TWC that this employee has been called back to work and he no longer...
Exactly. Exactly. One more question has come up. Can you hire new employees over the number you had over February 2019 and get those payroll costs forgiven? Yes. And can you convert some W-9 employees to payroll to take advantage of the program? Specifically?
W-9 employees.
W-9 contractors to employees.
Converting contractor to an employee.
Yeah, you can put the contractors to the employee. There is nothing wrong. I mean, if you offer a genuine terms of the employment, you should be able to.
Yeah. One more question has come. I think if the business is closed, still owner has to pay payroll to keep them for not filing for unemployment.
Well, that's the goal of the intent. So, the people need to understand that the government doesn't want employer to say, hey, the business is shut down, go and file employment. Because that is going to sever the relationship between employer and employee is going to start looking for work somewhere else. Whereas the goal of the government is to continue to feed the oxygen and blood in a measured way, so that the business can come back alive well and alive and thrive, so that the employer doesn't have to look for the employee going forward once the COVID situation goes down. And that is why they want to continue to pay, and they expect that they should be able to come back within 2.5. Now, they don't know how long the virus is going to last, and that has been questioned, and the virus can only answer how long it will prevail. So that Dr. Fauci has said loud and clear, nobody, not even President of the United States, knows how long the virus situation will prevail. So when these laws were passed, they thought that 8 to 10 weeks should be a reasonable time, and that's how they appropriately responded with 8 to 10 weeks of the pay and PPP and all those things. Now, if the situation worsens, the leadership may come back with some other measured response, but we don't know now.
Can we use the payment towards employer portion of 401k towards loan PPP forgiveness?
I don't, so the employer's portion of the, no. This is only the payroll as well as the health insurance payment.
No, it's covered. It's
Covered?
401k
yes,
is also covered. Cafeteria
yes,
plan will be covered on that.
correct.
Okay.
Up till 100,000 of that employee's annual wages salary.
It's about that. It's about that. Like 100,000 plus the other cost, meaning health insurance.
Exactly.
And,
But
401k cost.
100,000.
Yes.
Okay. So the next one is about a question. How is the what about the employee retention tax credit? Can that be used after the PPP has been utilized?
There are two conditions. I mean, if you see the retention credit, one is that the business operation has to remain fully or partially suspended as a result of COVID, and I think there has to be a significant decline in gross receipt as compared to the previous quarter. So that issue is going to be more elevated in terms of claiming ERTC, because I have seen some people coming up and say, okay, this second quarter we can use PPP. What about third quarter or fourth quarter? And can we use ERTC? And the issue is that, hey, are you open for business? If you are open for business, then there is no question of ERTC. Or if you have shut down and you cannot reopen, then yes, but then the guidance will be forthcoming. So this is something evolving. Let's not jump to the conclusion.
Thank you, Mahesh Bhai. I will just give a last question on that, and then we will go over on your thoughts for the last break, kind of. So how is the 25% reduction clause apply for employees with more than 100,000 annualized income? Or the 25% reduction applies only to the first of the 100,000 of the wages?
So
did you get this question?
Yeah, I see the question. So the employee who is covered under the PPP program should have a maximum $100,000 of income in the calculation. So I have not seen 25% reduction clause. Where we are looking at 25% reduction clause, I don't know.
Okay, so that might be a specific question that has to be reached out. So with that, I would say, I think so we are towards the end of the program. I would like to thank the Chamber and of course IDA for partnering for this. This was quite intentful and very intense. There were a lot of numbers, and quite detailed kind of a thing. Remember, the intent of the government is to have small businesses run, because they are the fuel engines of the economy. This is a huge Marshall Plan which the government has undertaken to bring back the businesses on a robust standing. So we as taxpayers and tax preparers are taking all it the way up to make sure that we are out of this cycle as soon as possible in this global economy, and we are not laid back. The compliance, the forgiveness, and more kind of things would be coming up eventually. There are a lot of things which are changing on a day-to-day basis, but patience is what is needed. With that, Jagdeep ji, I will close out, and thank you all the panelists.
Swapan ji, thank you very much. I want to first thank Mahesh Desai ji for sponsoring today's event. Swapan ji, Mahesh ji, Rimple, and a host of other CPAs have, for the last 10 plus years, been serving the community by serving on a panel every year to talk about the American tax laws as they apply to our members and the community. And when this COVID hit us, Swapanji had sponsored the first CARE PPP event about 5 or 6 weeks ago. And we want to thank him for launching this series and agreeing at the request of the Indian Doctors Association on putting together today's event, which Maheshi is sponsoring. And Rimple, we'll give you a chance to sponsor the next one if you're interested. But jokes apart,
Definitely.
we want to thank the three of you for making the time, because these are very busy times for you, because as the director of the SPA said, in 14 days, they had to disperse 14 years of loans. In the past, what money they have given in 14 years, they dispersed in 14 days. And he, on one of the radio programs, mentioned it was like flying an aircraft while it is still being built. I do want to reiterate that what we do in these webinars is just to educate you. We urge that you go to your CPA, your tax professional, to seek their professional guidance to make sure that you make no mistakes, because we cannot accept any responsibility for any misunderstanding of the information that is shared. We are all human. So on a program like this, several times I make mistakes in my diction or in my pronunciation or other areas. So I would definitely suggest that before you file your documents, please consult your professional. If you do not have a professional, the three who were presenting today are the best in the business. Join me in thanking the Indian Doctors Association for the great work they are doing, being our frontline defenders in these very serious times. We've always called the armed forces the front line, but here it's the healthcare professionals that are really fighting this battle for us. I would like to thank Pooja Shah with the Indian Doctors Association and Bhavna with the Chamber for all the work they have put in putting together today's event, and Dr. Jignesh Shah and every one of the doctors who are members of the Indian Doctors Association for their continuous support of the Chamber and for the great work they are doing. With this, today's event is over. We have two upcoming events. We will be hosting a webinar with Commissioner Adrian Garcia, who will be talking about the great work he is doing for the community and for the small businesses. He was, if you remember, responsible for leading Harris County in a $10 million loan program, which is actually a grant program for small businesses, which got subscribed in less than 24 hours. But he does a lot of great work. And we have another panel with Dr. Vivek Kavadi hosting coming up, in which we will be taking the discussion on the COVID-19 forward. So visit the Chamber website or email info@isccgh.com for information. But the Chamber will continue to serve the community with these virtual meetings till it is time to come back to our regular routine. Thanks again, everybody, for logging in. I am now requesting Bhavna to conclude today's webinar. Thank you very much.